Could a single Bitcoin one day be worth nearly $12 million? It's a number so massive, so utterly staggering, it sounds more like science fiction than a financial projection. Yet, according to Michael Saylor, the visionary, the technologist, and the man whose company has placed one of the largest bets on a single asset in corporate history, this isn't just a wild fantasy. He sees it as a calculated outcome, a logical conclusion from a thesis grounded in math, economics, and a fundamental rewiring of our financial system. In this video, we're going to unpack the stunning math behind this prediction. We'll explore exactly how he believes Bitcoin will first absorb the entire market cap of gold. And then, in a move that could redefine wealth, how he expects it to multiply that value by a factor of 10. This isn't just another price prediction. This is a roadmap for what could be the single greatest asset revaluation in human history. Stay with us as we break it down. To understand the prediction, you first have to understand the man. Michael Saylor is not your typical Wall Street analyst. He's an MIT-trained engineer, a student of history, and the executive chairman of a business intelligence firm he co-founded decades ago. For years, his company MicroStrategy was a successful but pretty quiet player in the tech world. That all changed in August of 2020. In a move that sent shockwaves through finance, Saylor announced that MicroStrategy had started converting its cash reserves into Bitcoin. It began with a $250 million purchase and just kept going. As of early November 2025, the company, which recently rebranded to Strategy to signal its new focus, holds a colossal 641,205 Bitcoins. This huge stake was acquired for a total cost of about $47.5 billion at an average price of around $74,057 per coin. Why would a public company make such an audacious move? Saylor saw a deep systemic flaw in our economy, the relentless debasement of fiat currency. He watched central banks print money at an unprecedented rate, eroding the value of savings and corporate treasuries. The cash on his balance sheet, once a safe asset, had become what he calls a melting ice cube. This sent him on a quest for a perfect store of value, an asset that couldn't be created by political whim and could preserve economic energy over time. He looked at stocks, bonds, real estate, and precious metals. He concluded that while gold served this purpose for millennia, it was an analog solution in a digital world. Then he found Bitcoin. To him, it was the engineering breakthrough that solved the problem of money itself. Pivoting his company wasn't a reckless gamble. In his view, it was his primary duty to protect his shareholders' capital from the silent theft of inflation. This move created the blueprint for the corporate treasury strategy, inspiring other companies and positioning Saylor as the leading voice for a new financial paradigm. Before we get to the price, we have to understand the bedrock of Saylor's argument, that Bitcoin is, from an engineering and economic standpoint, the most perfect form of money the world has ever seen. This rests on a few core principles. First, and most importantly, is absolute scarcity. Bitcoin has a mathematically enforced supply cap of 21 million coins. That number can never change. Think about that for a second. Every other form of money has had a flexible supply. Governments can print endless currency. We find new gold veins and invent better tech to extract it, increasing the supply by about 1 to 2% a year. Bitcoin's supply, however, is perfectly inelastic. Its issuance schedule is written in code, making it the first truly finite asset in history. Saylor sees this as its ultimate hedge against the rampant money printing of our time. Second is Saylor's famous concept of Bitcoin as digital energy. He often says to think of money as monetary energy. Historically, we've stored this energy in things like land or gold bars. But these physical assets are clumsy. They're heavy, slow, and expensive to move and secure. Bitcoin, he argues, is the technological leap forward. It converts raw thermodynamic energy, the electricity used by miners, into a pure, weightless digital form. This energy can be sent anywhere on the planet at nearly the speed of light without permission. You can't put a tariff on an asset that lives in cyberspace. You can't seize it without the private keys. It's the most efficient system for storing and moving value ever created. Third is its decentralization. There is no Bitcoin CEO or board of directors. No single country controls it. The network is run by a global voluntary group of nodes and miners, all following rules written into the protocol. This neutrality makes it a truly global asset. For the billions living under unstable currencies or authoritarian regimes, Bitcoin represents the ability to own property without asking for permission. As Saylor has powerfully stated, if you have Bitcoin, I can kill you, but I don't get the Bitcoin. It's a stark illustration of the financial sovereignty it enables. Finally, there's its portability and divisibility. Imagine moving $1 billion in gold. It would be a logistical nightmare of armored trucks and vaults. With Bitcoin, it's a few lines of code and a transaction that settles in minutes for a small fee. This ability to move vast sums effortlessly is a game changer. When you combine these properties, you see why Saylor doesn't view Bitcoin as just another crypto. He sees it as a new elemental force, a foundational layer for the 21st century economy, destined to demonetize weaker stores of value. And the first target on that list? Gold. The first logical step in Saylor's grand thesis is the demonetization of gold. For 5,000 years, gold has been humanity's primary non-sovereign store of value. But according to Saylor, its reign is ending. He argues Bitcoin does everything gold does, but better. It's harder, smarter, faster, and stronger. Think of it as digital gold. It has gold's scarcity, but makes it absolute. It has gold's durability, but makes it weightless. It has gold's history, but compresses it into a programmable protocol accessible to anyone with an internet connection. The physical limits of gold are becoming more obvious in a digital world. Transporting it is expensive, verifying its purity is hard, and it's subject to seizure and tariffs. Bitcoin has none of these drawbacks. Saylor believes we're in the early stages of a massive capital migration, from the analog safe haven of the 20th century to the digital one of the 21st. So, what does this mean for the price? Here's where the math gets fascinating. The first milestone is for Bitcoin to absorb gold's entire market capitalization. As of late 2025, estimates for gold's total market cap range from around $21 trillion to over $28 trillion. For our calculation, let's use the lower end of that range to stay conservative. If Bitcoin were to achieve a market capitalization of $21 trillion, what would one coin be worth? The calculation is simple. Divide the total market cap by the total supply of 21 million coins. $21 trillion divided by 21 million Bitcoin equals $1 million per Bitcoin. This isn't a wild guess. It's a calculation based on Bitcoin replacing gold as the world's premier store of value asset. Saylor himself has frequently discussed this milestone, suggesting a price of $1 million per coin could be reached in the next 4 to 8 years as institutional adoption accelerates. But this isn't the final destination. This is just phase one. Reaching $1 million per coin is just the first leg of the journey. The second, more explosive part of the thesis is what happens after Bitcoin is established as the world's primary reserve asset. At that point, Saylor argues, it won't just replace gold, it will become the foundational layer of the global financial system. Capital won't just flow from gold, it will start to flow from every other asset class people use as a store of value, but which are fundamentally flawed. Think of government bonds with negative real yields, the vast capital in indexes like the S&P 500, and the hundreds of trillions in real estate often held as an inflation hedge. Saylor has argued that Bitcoin will eventually demonetize a portion of all these assets. This leads to the 10 times multiplier concept that underpins this video's title. Once Bitcoin flips gold, its network effects and status as pristine collateral will cause its value to expand far beyond the yellow metal. Let's run the math on that. If we take a higher end estimate for gold's market cap, around $27.8 trillion, a tenfold multiplier would imply a future market cap for Bitcoin of approximately $278 trillion. Now let's do the same calculation. $278 trillion divided by 21 million Bitcoin equals roughly $13,200,000 per Bitcoin. This is how analysts arrive at figures in the $11 million to $13 million range. It's a two-step process. First, absorb gold's value, and second, apply a multiplier. It's crucial to clarify attribution here. While this calculation is an interpretation of the framework Saylor laid out, he is careful with his own public forecasts. His actual long-term prediction is that Bitcoin will appreciate by about 30% annually for 2 decades, which would lead to a price target he has personally articulated, $20 million per coin within 20 years. So, while the absorb gold then 10 times model gives us a figure near $12 million to $13 million, Saylor's own projection is even more ambitious. The numbers differ slightly, but the thesis is the same. Bitcoin is on a path to become the most valuable asset in the world. A multi-million-dollar price target is one thing, but is there any evidence this is actually happening? Saylor's case for credibility rests on a powerful dynamic, a massive and growing imbalance between demand and supply. The first pillar is the institutional stampede, kicked off by the launch of spot Bitcoin ETFs in early 2024. This was a watershed moment. For the first time, giants like BlackRock and Fidelity could offer their clients direct, regulated exposure to Bitcoin. The floodgates opened. These ETFs began hoovering up Bitcoin at a breathtaking pace. While flows fluctuate, there have been extended periods where ETF demand has dramatically outstripped the new supply. For instance, in December 2024, ETFs purchased nearly triple the amount of Bitcoin that was mined. There have been other periods where institutional purchases have outpaced new supply by a factor of over 5 or 6. This isn't just a trend, it's what Saylor calls a demand shock. The smart money has arrived, and it is systematically draining the available supply. The second pillar is the corporate treasury playbook that Saylor himself pioneered. Following his lead, dozens of public companies have added Bitcoin to their balance sheets. Collectively, public companies now hold just over 1 million BTC, which is more than 5% of the current circulating supply, and that number is growing. These corporations aren't day traders, they are long-term accumulators, locking away Bitcoin for years. This creates another persistent source of demand. The final, and perhaps most powerful element, is the supply squeeze. While demand is exploding, the creation of new Bitcoin is programmed to get scarcer over time through an event called the halving. Roughly every 4 years, the reward paid to miners is cut in half. The 2024 halving slashed the daily issuance of new Bitcoin from 900 to just 450. Now compare that dwindling supply with the exploding demand. You have a fixed and shrinking supply colliding with growing demand. From a purely economic standpoint, there is only one possible outcome. The price must rise. If you're getting value from this deep dive and want to stay ahead of the biggest financial trends, take a moment to subscribe and hit that notification bell. We break down the complex ideas shaping our world so you can be prepared for the future of money. Of course, no thesis this audacious comes without skeptics. Let's tackle some of the most common objections. The most frequent criticism is volatility. Critics argue an asset that can drop 20% in a week can't be a reliable store of value. Saylor has a powerful response. Volatility isn't a bug, it's a feature. He famously says, volatility is vitality. An asset monetizing from zero to trillions of dollars will naturally be volatile. Each surge brings new adoption, and each correction shakes out weak hands and solidifies a new, stronger base of long-term holders. He frames it as the price you pay for a ticket on the lifeboat. He believes this volatility is now diminishing as the asset class matures. Another concern is energy consumption. The Bitcoin network uses a lot of electricity, leading many to label it as environmentally irresponsible. Saylor counters this aggressively, arguing that Bitcoin mining is the most efficient and cleanest industrial use of energy. It incentivizes cheap, renewable energy and can monetize stranded energy that would otherwise be wasted, like flared natural gas. In this sense, Bitcoin acts as a global buyer of last resort for energy, helping to stabilize power grids. Finally, there's the specter of regulation. For years, critics warned that governments would just ban Bitcoin, but the tide has turned. The approval of spot Bitcoin ETFs by the US SEC was a monumental regulatory green light. It brought Bitcoin firmly inside the regulatory perimeter of the world's largest financial market. Far from banning it, governments are now creating frameworks to integrate it. The conversation has shifted from risk to strategic advantage. So, what does this all mean? Michael Saylor's thesis for a multi-million-dollar Bitcoin isn't a hopeful guess. It's a logical progression. It starts with Bitcoin's fundamental properties, absolute scarcity, and its nature as pure digital property that make it a superior store of value. The thesis then unfolds in 2 phases. First, Bitcoin is positioned to absorb the market cap of gold, its analog predecessor, which would place its price around $1 million per coin. But it doesn't stop there. It then expands to become the world's ultimate reserve asset, drawing capital from underperforming bonds, indexes, and real estate. This multiplier effect is what leads to valuations in the realm of $11 million, $13 million, or even Saylor's own long-term target of $20 million per coin. This whole process is being accelerated by a massive supply and demand imbalance, where a tidal wave of institutional and corporate demand is crashing against the shrinking wall of new supply. This points to something far bigger than just an investment. It's a paradigm shift in how we store and transmit value. We are witnessing the monetization of a new global asset in real time, a process that will likely create and destroy trillions of dollars of wealth. This video is not financial advice, but these concepts are essential for anyone thinking about their long-term financial security. In a world of currency devaluation, the search for a reliable store of value has never been more critical. Understanding the argument for Bitcoin as the ultimate solution is a crucial piece of financial literacy for the 21st century. The digital transformation is here, and it's happening faster than many imagine. If you want more deep dives into the forces shaping our financial future, make sure you subscribe and hit that notification bell. Now, we want to hear from you. What do you think of Michael Saylor's math? Is a multi-million dollar Bitcoin inevitable or is it a fantasy? Let us know your thoughts in the comments below.